Ladies and gentlemen, after reviewing the Twtr chart, I have come to the conclusion that we are either at or very near strongly shortable highs. Now I'm going to go through the technical analysis that confirms this. First, we'll do the real easy one. Volume. Lots of green buying volume. Notice here, lots of green buying volume, just in short in front of a big sell-off. Notice back here, spike higher, lots of volume, boom, sell-off. Positive volume, a lot of people say, oh, don't buy it unless there's strong volume to the upside. Well, more often than not, when you buy into strong volume to the upside, you're buying into Wall Street's tail, that if there's strong volume to the upside, it's going to stay. Keep in mind that market makers, you see these big red ticks. Market makers, those are the days the market makers are buying. They don't care how long they have to hold the stock in order to get rid of it, but once they've decided to take it up, they take it up. And all the way what they're doing is selling all those volume spikes that they bought back here. They're loaded with stock when they're starting that uptrend. And when they're first selling, they're selling for small gains, but they know they're going to keep pushing it up, selling more and more. In this case, take a look at these volume sell spikes in the 18s, volume sell spikes in the 16s, volume sell spike 16. So as this wave has started upwards, they're making lots of money. Now, since they started this push higher, which they started it with their own volume push here, you can see we've had several nice spikes of buying volume, and now we're hitting a nice long buying trend. This is when mom and pop are loading up with bear because they've got positions at 30, they got positions at 34, they got positions at 40, and they want to be there to 100. Well, Twtr has a 2,500 PE at this price, 2,500 times earnings. Should never even have gotten here. This is New York, Wall Street's market manipulation. Let's take a look at some other reasons why we see technical difficulties. Look down here, you'll notice that the ADX and the PPO have both made a scream higher. The PPO is already at a level consistent with failure. It's above it. And the ADX, 1 or 2 days, it's going to be consistent with previous highs. And when an ADX gets high, let's look at the first one. You notice it was some weak selling because the market makers weren't done with the stock. They still had too much stock. So they just relieved the technicals before the next run. Come over here, you have a very traditional topping pattern with a 3, 4, and a 5 up. 5 up followed by a technical ABC down for a big 4. See, under Elliott wave theory, this would be a wave 1 high, a wave 2 low, a wave 3 high, a wave 4 low, and then we've got a 1, 2, and this very well could be a 5 in a lesser degree of trend. But you never call something that small a wave. So worst case scenario, we've got a drop and a rally to a final high. Often fifth waves never make it to that final high because too many people are too quick to pull the trigger and get out. So if a stampede starts, don't be afraid to jump on it. It is a short. Would I buy it today short? I don't think so. Unless there's a gap down Monday, say it gapped down to 44, and didn't recover more than 30 or 40 cents of that, and then continued selling, an open gap right behind inside the field of that day means that it's covered, and it's perfectly fine. So a rally back into that field before continued selling says that it's going to get very bearish, it's going to get very bearish very fast, and you should be on the mark to get short. These two, what you really want to see for a safety purpose is see where these red lines cross. In this case, it was a gap down. You'd have shorted it here, taken it down. Once the line passed below zero, any strength whatsoever, you'd have abandoned the position. Same thing here. When it comes down and gets below zero, any strength, you're going to abandon the position. You see over here, once that line started to turn, boom, we're on our way up. A couple of small days and then some stronger ones. Another nice thing to see before you get a final high is to see that green plus D1 cross through the minus D1. Doesn't have to be as exaggerated as this, because this was a third wave. These are very predictable, very buyable, very sellable. You know what's going to happen. You're always looking for that negative divergence. But if you look up here in the stochastics, you can see we already have negative divergence forming. It's already declining into strength. And those open gaps, like I said, anybody sees those on the way up and it's based on fundamentals, that's a wonderful thing. But the fundamentals of Twitter don't suggest anything like this is possible other than market maker manipulation. So we are going to put this on a sell, short gap down or short into a second high. One of the two. If you have a little grit, you could short it right now and just finish the ride. It's not going to be very high, probably around 50 at best. But when the decline comes, because of this extreme overbought condition, you're going to see a healthy decline. Ladies and gentlemen, I just thought you might want to know Twitter is about to become the short play of the month. Ladies and gentlemen, this is a brand new stock channel, although I've been trading most of my adult life. I hope you'll take the time to like and subscribe, and in the beginning we're going to be bringing you few and far between videos, but as time goes by the frequency will increase, and we're also going to be looking at training videos, teaching you how to read charts so that you don't need me. With that said, like and subscribe, and I'll see you in the next video.